Today, we're going to talk about why I think the S&P 500 is expensive. In fact, if you've been watching my videos for the past number of months, I've been talking a lot about the S&P 500 being expensive, but I also want to talk about why I think the Asian Pacific region are offering extremely good value at this point, especially with markets being what they are lately. Let's get started. Well, I want to start off with the relative valuations of markets across the world, the developed markets, and I'm going to give you a chart courtesy of worldperatio.com. These figures are about a month old when the markets were a bit higher, but it'll still give you a sense of proportion as to where the US market stands versus other economies. So here we go. This is the United States representing the S&P 500, and you can see about a month ago, back in about late January, early February, the PE ratio, when the markets were higher, was trading around 25 times. Now, proportionately, if we go down to China, which is one of our subjects today, you can see the PE ratio was around 10. Now, keep in mind, its PE ratio is a fairly simplistic way of looking at markets because you have to take into account earnings growth. We're going to talk about earnings growth right now, but I want you to keep in mind that up to this point, US markets have been very, very expensive against literally every other developed market in the world. Now, currently, PE ratios on the S&P 500 are around 22 times. You guys know in February and even into early March, as I'm recording this, the markets have been falling. Well, falling prices on the market means the PE ratio shrinks. So we're sitting around 22 right now on a forward earnings basis. That means that what analysts are projecting earnings will be in the year 2025. So let's take a look at what that means. Well, first of all, I want to just mention something here, and that is the long-term average on the S&P 500 for the PE ratio is 16.5 times, and I've mentioned this in a prior video. So what I want to point out then that at 22, we're still expensive based on historic metrics, let alone what we look like versus the rest of the world. So 22 times earnings times the estimated forward earnings by analysts of $240, that would work out to be a current value on the S&P 500 of about 57.60. And funny, as I talk today, that's about where the S&P has retreated to. So that's interesting. You could say that the market is trading about where it should be, but the question is, if long-term averages are around 16.5 and we maintain that $240 average, well, do the math, 16.5 times 240, the S&P 500 could retreat to below 4,000. This is not a prediction. This is just a possibility, but it's giving us a pretty clear picture on where the valuations are in the S&P 500 compared to history. Now, I want to do a direct comparison first on the growth of the Chinese market, because one of the problems has been for China in the past few years is that they had a massive real estate problem, as many of you may be aware of, and their earnings growth has fallen out of bed. Their tech stocks have suffered in particular, and that's been a key driver for that economy. Well, guess what? This chart shows us that tech stock earnings growth, which is represented by this red line, is hooking up. That along with M2 money supply growth, it's also improving, and that's a key driver for the economy as well. So China looks pretty good from a turnaround perspective. If you like turnaround situations like I do, this should catch your eye. Let's now take a look at the broad Chinese stock market. We're going to look at the, this is the iShares large cap ETF. It's FXI on the US Stock Exchange, New York Stock Exchange. And you can see that it has actually been in a bit of a consolidation for a number of years, since 2022, but it's been breaking out recently. The breakout point was around $33. It seems to have done that. It seems to be holding above that level. This is something we should watch, because if that breakout can maintain, you've got lots of upside to return to the old highs. They always say the greater the base, the better the case. Well, we have a pretty good base since 22 on this index. If it breaks out, could be very powerful. Now let's take a look at the tech stocks, which I did mention are an extremely important part of the Chinese economy. KWEB, KWEB, is the I think it's Crane Shares ETF that is a very, very widely traded ETF representing the Chinese tech stocks that you're familiar with, like Alibaba, Tencent, and all that. So what you're seeing here is a long base that has not yet broken out. So we need to see on this ETF around $35 breakout. And if that does, take a look at the resistance levels that we could offer as targets. It's currently around 35. If it broke 35, and let's say we bought it around 40, you'd then have a $50 target, and then you'd have a double to an $80 target. So I'm not making any predictions. I never do. I follow the charts. I follow the tape. But breakouts be breakouts. And if this happens on KWEB, you're going to see some action. So I want you to keep this on your radar. I don't think it's a buy today, but I do think it's a very interesting prospect. Now, it's not just all about China. I want to talk a little bit about some of the Asian Pacific emerging economies as well. So I'm going to talk about something called the Asian, spelled ASEAN. So this isn't a spelling mistake. I'm notorious for making spelling mistakes on my slides. I am a financial guy, not a literary genius. So I want to point out that I didn't spell this one wrong. It's called the Asian PMI, which is the manufacturing index. And what we're seeing is it's the highest in the past 6 months. Just FYI, the Asian index represents China, India, Indonesia, Philippines, Thailand, and Vietnam. So this is a pretty good index because it does include the mothership, China, but it's also got a lot of these other economies which actually have been doing okay even before China started to see some action. So the index recently rose from, and I'll try to zoom in here, from 50 to 51. So it's gone up, and in fact, it's at 6-month highs, like I mentioned a moment ago. So that's good news for this region. Final chart I want to look at is the Asian Pacific overall index, which that Asian PMI index fundamental thing we were just looking at represents. So we can look at the stock indexes of the combined countries we were just talking about, and you can see on this index, which is GMF, it's the SPDR S&P Emerging Markets Asian Pacific ETF, GMF on the US market, and you can see it's been in a very nice uptrend. In fact, if you look back to 22, that breakout happened quite some time ago, early 24. So it's positive news. The other thing I want you to notice is that it has been consolidating in what looks to be like a bit of a triangle. A triangle is when you get higher lows, which we've had, and lower highs, and eventually that triangle comes to a point where prices consolidate and the market never likes to sit still. So it breaks out. Now it could break out to the downside and it could break out to the upside, but chances are, based on everything we just looked at, all things being equal, that this market could break out to the upside, and I think it has a decent chance of outperforming the S&P 500. And that really was the point of this ETF discussion, wasn't it? It was the point of our video, is that there's opportunities outside of the US markets. Even with the craziness that's happening surrounding the Trump tariffs lately, we are seeing opportunities in Asia Pacific, Europe, and other countries, and I will address those opportunities in upcoming videos. So I do hope that you enjoyed this video, and don't forget, like and subscribe. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at Value Trend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years, and in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk, spam, and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a long-time portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.